Hello, friends, clients, and colleagues. Today is Monday, about 3:30 p.m. West Coast time, and it's time for a timely market and economic video update. My name is Rich Siegel. I'm the managing partner, a wealth advisor, and director of finance and investments for ARQ Wealth.
And I'm Justin Rivera. I'm a wealth advisor and associate portfolio manager at the ARQ Wealth Denver office.
Great. All right, Justin. Today's agenda will be the economy and the Fed, then the bond market, and then the stock market. So let's jump right in with the economy and the Fed. Last week, Jerome Powell and crew had their FOMC meeting, and the announcement was made last Wednesday for no rate cuts. What are your thoughts?
Yeah, so I think that our expectation was that there wasn't going to be a rate cut. I was expecting a little bit stronger signaling towards a September cut. We got a little bit of signaling that way, but not as much as I expected. Um, we got just a couple of days later, we got a jobs report that I think in hindsight, if they were to have that, I wouldn't have just expected some signaling in September. I would have expected a cut now. And obviously we didn't get that. But I think at the very least, in the coming days or weeks, it would be nice to hear from the Fed, and maybe they can give us some stronger signaling as to what they might do in September. It could be one cut. I mean, at this point, it could even be two cuts. And so you can see here on this chart or graph, we've shown this a couple of times, but this green line is the market expectations of where Fed rate cuts go, or the Fed funds rate, where it goes. You can see right now at the very top, that gray diamond is 5.38%. The market is expecting that we are more than 100 basis points lower just by the end of the year this year. That is a big discourse from where we have seen that line in the past. And I think that as of now, again, market expectations is 100 basis points. If we see data going in the direction that it has been, I don't think I would be surprised with even a little bit more than that. On the left side of this page, there's some numbers of where we are on unemployment, CPI and PCE. That unemployment number was as low as 3.4%. Typically in the past, when we've seen increases in the unemployment rate of 0.5% or higher, that usually has been predating recessions. And now we're at 0.9% higher than where we were. Not saying there will be a recession, but that is a big spike in the unemployment rate, according to history. That CPI number of 3%, if you remember, was as high as 9.1% at its peak, has dropped all the way down to 3. That's what we like to see. And then on the PCE, that's Jay Powell's favorite inflation measure. That was over 5% at its peak, and now we're down to about 2.6. And the target on that core PCE, if you remember, is 2.0%.
Right. So the Fed's dual mandate of full employment, and by the way, full employment really 4.5% is still considered full employment. So we're close to the inflation targets. We're still at full employment, but if things keep moving in the direction that we saw last week, that would not be good for the economy or the job market, obviously. So, yeah, I think the next meeting is about 6 weeks away. So being kind of preemptive and doing an emergency cut just because of one really bad number last week would probably spook the markets even worse. So I think you're right. I think maybe we hear from the Fed, some soothing words, and then maybe we see the next Fed meeting in 6 weeks. Maybe they drop it by 50 or even 75 basis points. How far we've come in a couple of weeks.
I know.
Bond market, bonds acting like bonds finally, right? Bonds and stocks have been moving in tandem for quite a while. That's hard. It's been hard to diversify when everything's going in the same direction. But in recent weeks, months, you can see that rates have really come down a lot. The 2-year Treasury is the blue here, and the 10-year is the red line. And they've come down by over 1%. So bonds, in turn, have returned just about 4% in a month. So that's really been a nice break from all the stock market turmoil. We've liked bonds for a while here, cheap prices and higher yields. We saw the same thing in the fourth quarter of 2023, the same kind of setup. Rates come down, bond prices go up. So that's where we are today. It's good news. And also, like we just mentioned, all these CD and money market rates at 5%. When the Fed cuts rates, let's say they cut rates by 1%, like the futures are forecasting, you're looking at a full 1% lower yield on cash by the end of the year. So maybe we've seen the peak rates for, who knows, it could be decades to come. Finally, we'll talk about the stock market. Lots of action here. Today's reaction, it seems like an overreaction almost, but it's kind of a confluence of events. I think the Israel and Iran conflict escalating, it causes anxiety. Obviously, the reaction to the recent weak economic data. The market has been quite expensive, so letting some of the air out here is probably a good thing. The old saying is the stock market takes the escalator up and the elevator down. It comes down quick. The good news, we feel that the Magnificent Seven, these big tech names that were really in nosebleed valuations, have led the way down, and that's a good thing. If things get too out of control, then you have bubbles. The VIX is the fear indicator is at 38.5. I mean, that's up like 200% in the last few weeks. It was at 12. A VIX of 38 implies about 2.5% movement in the market daily. So if the Dow's at 40,000, 2.5%, that's 1,000 points. So an elevated VIX is what you see when you have fear, peak fear in some cases, and it's usually a great time to put money to work, because as that comes down, the market goes up. And then, of course, valuations have gotten more attractive as prices have come down. Do you want to mention something also about the Japanese yen situation?
Yeah, absolutely. I think we have to mention at least that that's having an effect as well. We've seen the Bank of Japan feel comfortable with hiking rates. We've seen obviously the Fed expects to cut rates. When we see those moving in opposite directions, we're actually getting some ripples in the financial markets, and you're seeing that as you can see with the Nikkei index and what that performance has done over the past day, and then we're seeing that a little bit of the spillover of that in U.S. markets as well. Look, I mean, days like this happen, and come easy, go easy. We've added $1 trillion in market cap at the beginning and towards the middle of the year at really lofty valuations. We've lost $1 trillion in market cap. What I am surprised about is how quickly it happened, but I think that just like you said, the saying goes, escalator up and elevator down. Again, surprised at how fast, but confluence of events all happening at once is probably a little bit of a cause of that. But as we see it today, corporate balance sheets are good, consumer balance sheets are good. I think we can push through this in a healthy way, but we'll have to see.
Yeah, we even said a few weeks ago in our last video that a great setup into year end would be the market takes a step back, consolidates, right? The market pulls back 5-10%, earnings move up in the right direction. Usually the second half of the year, in a presidential election year, the market is very strong. But yeah, I mean, from a seasonality standpoint, August and September are the worst months anyway. So to have a period of turbulence and weakness here is not a surprise at all. From a strategy standpoint, we do have some dry powder. And if we see another, let's say 5-6% down from here, we think it'd be a great time to rebalance portfolios. Just for context here, we could see that through today, off the all-time high of the recent all-time high of just a few weeks ago, the S&P 500 is down 8.5%. The Nasdaq's down 13.25%. The Dow's been the best of it. Laggard on the way up, best on the way down 6.5%. Foreign markets 8.25%. And then here's those Magnificent Seven tech stocks getting hit really hard. Nvidia and Tesla are the worst of it, about 29% drops. Apple down 12, Microsoft down 16, Amazon down 20, Meta down 12, Google down 17. Something else, about every year and a half or so, we have an actual correction that's a 10% or more market retracement. The average correction historically has been minus 14%. So we're more than halfway there. So maybe some more to go. But we think a lot of the damage has been done. And then we're estimating here, we don't have all the numbers yet, but I believe that as a firm, our clients are down about 3.5 to 4.25% from their peak just a few weeks ago. Nothing like the markets or these tech stocks. So we aim to have a smooth ride and protect wealth on the downside. So with that, we're going to say goodbye for now. Thanks for listening, and we hope you have a great day.